What's up, guys? Just getting logged in here. Just getting logged in. Hey, what's going on, Martin? Good day to you. What part of the world are you in? All right, guys. Some of you are logging in on the Zoom side, so I have a chat. Feel free to interact there. If you type a message, you can actually put it to all panelists and attendees, so everybody can see your chat. That's usually how my guys do it. Oh, Germany, nice, nice. I've always been a big fan of your World Cup soccer program. I tried many a times to make the Olympic team, the Olympic development team back in the day. Couldn't quite get there, but I don't know if you're a soccer or football fan, but and the Germany squad is always just, they're a machine. The way they move the ball, the way they possess it, it's much different than the U.S. program. The U.S. program is getting better, but when I grew up, man, it was just long ball. It was awful. South Africa, nice. What's up, Santiago? I know. What's up, Scott? What are you guys trading today? Jobs number was pretty good. You know, the headline number is not what really matters. It's what it's doing on the margin or what the cycle looks like. So when you look at the jobs number, the best way to compare it is look at this month, compare it to last year, the same time, the year over year figures. And when you do that, you can get a nice curve. You can see the cycle, and then you can really see, because it's not, is a number good or bad? Is it getting better or worse? And so, plus that data is reflecting, you know, the strength a month ago. And so, yeah, the number was good, but it's not the end all be all. The inflation stuff is what really matters when we talk about growth and inflation. I guess we could just talk real quick about, since it is a jobs day. Most the pundits on TV will talk about, you know, they like to anchor on one thing. So today I was just listening. I like to listen to get a feel for what the groupthink is. And so everyone's was afraid of inflation, and pretty much all of Wall Street has bought into this idea that we're going to have inflation. And well, inflation started to do this the last couple of months. So we had a big acceleration, and now it's starting to roll over again. And you can see that in the price of oil. It was a great leading indicator of that. And let me make sure I'm sharing the right screen here. Okay, good. So just a little global macro viewpoint, but when you look at the First of all, we talked a lot about oil coming into a big picture area, but when you look at the CFTC futures and the options positioning, the two biggest crowded trades is long oil and short bonds. So everyone's anticipating rates are going higher and inflation's back. And then everyone's thinking that oil is going to continue to do what it's doing. And that's been the complete opposite the last several weeks here. So long-term oil basically is it should struggle up near closer it gets to 70, just because it's halfway down the overall trend. It's the first time we've retraced this entire move. And in our model, you tend to get lower highs right at or near the bands here. And that's exactly what you have on the long-term view. You know, most people on TV will never even talk about a monthly chart or price action reverting to levels that you haven't seen since 2014. And that's a cyclical phenomenon that's going to make there's reasons for why it should struggle. Our pie line's up here. But you can see that everyone's long inflation expectations, and now you can see that when you look at the data too, inflation's starting to kind of roll back the other way. It's not like it's falling off a cliff, but it's not going to be accelerating in the same fashion that we saw. When you take oil from the lows, oil's a big component of the CPI. We get that next Wednesday. And so everyone's expecting, again, more inflation. I think you're going to be surprised on the downside. And so anyway, when you move from 40 to 60, you're going to see a pickup in inflation. But the numbers are always lagging. So they're looking in the rear view of this move that already happened. Now that we've come off 66 and oil's making lower highs, if you get a rollover, if oil breaks down back below 60 and say it moves, if you break the bands here, you take this low out of 58, you could easily go back to 54, 52. And then all these inflation expectations are going to come off the table again. So that's, just focusing on that average hourly earnings, that's not the correct inflation picture. You're better off getting oil right. And so now everybody was crowded long on the highs, and same thing in bonds. It's just they're on the wrong side. That's classic consensus. Just everyone's chasing the same thing. Anyway. Yeah, Martin, you did? You guys got good leagues over there overseas, MLS is getting better here. I have my one buddy I grew up, played high school with, that played for the Rapids. And the sport's growing, though. It'll be interesting to see, I think, when Miami gets a team. I know Beckham, I think, owns that, right? I haven't really been staying up on that. So, guys, today I wanted to talk about a little bit of psychology of trading. Earlier in the week, and I think Wednesday, I kind of talked a lot about direction and kind of what we see. I mean, we've had some pretty good calls on staying core short the euro. You got more follow through today on euro pound, but this is still playing out. This plays into this idea of inflation kind of rolling over, also, especially in Europe. The reason why the euro keeps making lower highs here has a lot to do with Draghi has been pivoting back to dovish. And I've been saying that since 122, 123. I thought longer term, eventually as growth slows in Europe, they got hardly any inflation there. As that starts to come back off, he's not getting the data to give him any kind of inflation. So his only playbook is he goes back to dovish. And so that's what's been happening. I think you're going to continue to see that play out. So 125 is going to be tough to get through. And if the trend keeps slowing on inflation, you can watch Brent crude prices also. But that's why oil matters, guys. Everything's connected. So what the dollar does, what oil does, it's all reflexive. I mean, the dollar strengthens, Oil tends to come off, very high correlation there. The more oil breaks, the more inflation comes down, and that's what the central bankers, like to be fixated on. So always kind of paying attention to those things. But euro versus the pound is, something that I was calling out earlier in the week. We're high within the range. I think this is more to come down. The daily cycle is still coming down. But anyway, so let's talk a little bit about the psychology of trading. I'm always, the more I listen to people give presentations, and I hear more in the crypto space now. And there's just a lot of people that always want to talk the fundamentals and the valuation. That's okay. I mean, that's the fundamental analysis side of investing. And it has its place for sure. But it doesn't help you with the timing, which is the most important. And then so technical analysis has really been around since the 80s, and everyone's pretty much a technician now. I mean, there's so many books on it. There's so many great indicators and all these different charts. That wasn't the case when you were standing in the pit. Technical analysis was something they had to convince people of, like, trend lines and why price did what it did, and why that moving average might matter, or what's, all that stuff. So today that's pretty, that's something you can pick up pretty easily. But I think, I used to be very technical. I would put out a lot of technical research and be very specific in our trend lines and things like that. And as I evolved as a trader, it's just more about, it's not about absolutes. It's more about, thinking in terms of, not absolute terms, but everything's relative. So these are areas. These aren't specific points where you want to be bullish or bearish if it breaks the trend line. I mean, a standard deviation, this isn't a trend line up here I have on euro pound. This is just a range. And so just because you get outside of it doesn't mean you'd want to flip and be bullish. That would have had you buying the highs of this week. So anyway, technical analysis, obviously it does a good job with the price aspect of things, but it doesn't help with the timing component. And that's all the cyclical analysis that we work on. But then there's this other field, which is the mental analysis and the psychology of trading. And that's something that's just is just prevalent. And our theories too, that I want to talk about, this idea of chance, that's embedded in our economics and the way we think about investing in the economy is actually not really the right scientific way to go about this idea of chance. And I'll get into that in a second. But when we think about the psychology of trading, we want to think in terms of probabilities and not in terms of chance. So everyone thinks, well, trading or speculating and trading, it's just a gamble. You're just, there's no way to know in markets. And so at the same time, everyone wants to say that it's just a game of chance, but a game of chance is rolling dice or a roulette, the spinning of a roulette wheel. When Apple's stock price rises, it's not by chance. It's because there's X amount of people that saw the report that said they've sold X amount of iPhones. They increased their revenue and earnings by this amount. And then you have thousands of people go out and purchase stock with real cash and drive the price up. That's not something that just happens by chance. There's actual real cause and effect behind the price movement. But when we get into trying to forecast, we like the old model is, well, you can't do it in economics and markets, and it's just chance. But that's completely counterintuitive to the mechanism of markets. The thing you run into that's different than a lot of other fields like physics or all the different sciences, is that there's other aspects like anticipation that you can't put a coefficient on. Markets move on anticipation, which is more of a psychological or emotional metric. And that's something that's unique to financial markets. And so that's what the professors get wrong. When there's a guy on Yale on CNBC talking about the savings rate and why the tariffs were bad. And they always want to boil it down to one or two things, which is absurd. I mean, the economy is like a rainforest. You can't just talk about the monkeys and the ants and what they're doing and say that's bullish or bearish. It's crazy. The savings rate, we can have bull markets and bear markets. With a high savings rate, you can go back and look at the savings rate and find another time when there was, depression, because there was different levels of savings rates. It's not one or two things. And then you have to realize that we talk about the mental part of trading, and in the anticipation, markets will move in anticipation of what is maybe true or not true. And so that throws all the fundamental analysis out the window when you really get down to it. And you have to have a timing approach that has to do with probabilities, because we can measure and define probabilities based on the data and where something's been or where price is within a range. We can measure that, and we can see that something has an edge or a higher probability of occurring. And so the key is to think not in terms of markets. Markets aren't about a game of chance, or that's not the point. That's a real lazy way of that's just a lazy way of trying to predict markets. These analysts or these bankers or anybody that gets on that says you can't time them selling the high, or you can't buy the lows. It's garbage. Someone that doesn't have a timing process, that doesn't know how to trade, that's never bought the low or sold the high. And so it's not about, the key is to think in terms of where is the edge and where's the probability. I don't need to know what's going to happen next. I just need to know where my edge is. So the psychology of trading says, well, I can go to the gambling, the casino example, and say, well, I know the house is going to win because they don't care about the next hand or 5 hands from now. It's about the overall sample size, that they have an edge, that over time that's going to play out in their favor. Well, it's kind of very similar in markets, that we don't need to be all have anxiety about the next trade, or I got to be right on this particular trade, or I need to know when Bitcoin's going to bottom. As a trader, you want to have a system and a process, over the long term, over a lot of hands, where your edge is, and that you have a process. When I buy at higher lows within an uptrend, and I'm low within the cycle and I'm at the bands, I have a higher probability that that's going to be a lower high and move to a higher high. And so that over the long run, I'm not really obsessing about having to be right on every trade. It's about just defining my risk and thinking about where's my probability, you guys kind of with me so far? This idea of having to know really hurts traders. Like, I got to know what's next. Why? You don't need to know. It doesn't matter. You're going to win, you're going to lose. Sometimes it's going to work, sometimes it's not. You got to be more focused on, where's my edge? Am I sticking to my process? Am I sticking to my plan? That's what you got to be focused on, not trying to be right all the time or find something that's never wrong. It doesn't exist. So when I think about probabilities in the markets, I mean, you could run the numbers and come up with actual figures too. But I just care about looking at patterns and what tends to work, and combining in kind of a recipe that says, all right, well, for example, like, I know some of you guys probably want to look at crypto, but the probability that the market is going to continue without a bounce when the euro failed at 125 and moved to a new low and the cycle is low, the probability is that you're going to get a move back first before you take another leg down. That's simple. That's looking at where price came from, how it got there, over what amount of time, and where am I within the cycle that says, all right, the probability is that we can probably cycle back up. That's just an ebb and flow. It's just how energy moves. Before I think about it, I found this chart too along those lines. I wanted to share with you guys. But this is, let me share for the Zoom people. Look at this. I've never seen this before, but somebody did some charting here back in 1950. Forget the mathematician's name, but this is just flipping. This is a coin toss 1,000 times, and this is what the chart looked like. So when you talk to somebody that majored in statistics, I had statistics in college, and it's a tough class. I didn't do very well with it, but some of the theory there is that, and you can prove this on the roulette game too. When you flip a coin, the probability is whatever it is, 50-50 that you have heads or tails, and each random event should be, the same odds. Well, but that's not how the world works, right? You're still going to trend. I mean, this coin toss chart looks just like a lot of the stock market charts. So it just shows you that randomness doesn't move in what we think is just a line like this. It's not, randomness isn't like we all think it is. It's not a sound wave. It does ebb and flow, even on, that's just showing you that randomness even cycles. I guess is the point there. But like a roulette wheel, you got black. If you just bet black and red, you can try this. Just start playing and go. All you want to do is bet on black and red. And in theory, you should, looking at, well, we just had five blacks in a row. From a probability standpoint, the odds of the next wheel spin, just because there's 6 blacks in a row, it doesn't change the odds of that next event. Each event has the same probability, whether you're going to get red or black. And then, of course, there's the green ball. But the point is if that's not how life works. It trends. Things trend. So, some people have won the lottery more than once. Lightning strikes in the same place more than once. Even though the odds are so low, things still trend. And so that's just more of this idea that things just happen by chance. There's more to it than that. Let me go back to the chart. So you want a successful way to play roulette, you can bet around your winning and losing trades in the same way. So you bet a little bit on red, it's black, you lose. You bet again, it's black, you lose. But you can increase your bets as if you have 5 losing reds in a row, that the probability is not that you're going to have 8, 9, 10 red rolls in a row. That probability is really low. At some point, you're going to get an ebb and flow back the other way. And so when you get 5 reds in a row, you can get more aggressive with your betting, not because the next flip changes the odds. It's more about the trend. The odds are actually the same on every flip, on every roll, but when you look at it together, the odds of having 13 blacks in a row, can it happen? Absolutely. But the odds that you're going to get 14 in a row and then you get 15 in a row, those odds are so ridiculously small that you want to be on the other side of that bet. And it's the same thing here that I'm trying to describe on the euro, that the more down days in a row, the more down days in a week in a straight line, the probability increases that you're going to go the other way. And same thing when you stretch the energy from really high to like a brand new low, it's really hard for that to continue in the same line. That's why we use the wall concept a lot. It's about finding those edges and those probabilities of where, you know, I don't need to know what's going to happen. I just know that there's a wall here, and it's going to be hard for the bulls to go from a new low all the way back to the previous high without a move back in the other direction. Doesn't mean you don't have just a short move and then you're back on the highs. But if you know that that after this move down, the next bounce more than likely will be met by another ebb and flow the other way with the cycle, you can play your trade the next thing you got to ask yourself is, well, I got to learn how to work my size so that my average cost follows with the market, stays close to the market. And then when I do get that ebb and flow the other way, boom, then I'm in the money. Does that make sense to you guys? I mean, my traders understand this wall concept. But that's one of the ways of how we think in terms of probability, or where the edge is. So there's a good edge here to make a higher low. So if you were short, that's why we're saying, hey, we got to cover, because the probabilities are pretty high that the market can make a low here. So you cover, you take your profits. And then you do what? You wait for the higher probabilities. Same thing here on Bitcoin. Let me share my screen. I said it over and over that if you cannot get above 12,000 with the high in this cycle, and once we started to take out the prior day's low, the probability is that you're going to move back towards the bottom of the cycle, and there's a chance you can roll back over. That's where the probability is. Shouldn't even say chance because of the topic of what we're talking about. But the probability is that you're going to roll over. That's identifying the edge in the market. The edge was that, man, from the short side, 0 pound cable's coming back up here. Get distracted for a second. I was going to draw the line here. So that probability, I'll get your guys' questions in a second. You know, that cycle is awfully high. Did a great job last time. So that's how. So then question. So you know, we put out sell signals here to hedge. That was a great call. And now we've been saying just be patient. I mean, the cycle's only halfway played out. There's a good chance, a good probability you come right back down here. And then guess what? We'll be buyers at 7,000 for sure. You know, across the market. So you looking at coins you like when the market gets down here. Yeah, Santiago. Chance. Yeah. So some other things I wanted to share on this topic. Just looking at my notes, a couple of thoughts I was writing down. I talked about anticipation. Yeah, Jason. Yeah, so I know that's something too with the psychology of trading is beating yourself up just because you lost money. Well, losing is part of the game. What we want to get focused on is, did I make the right action? You know, you know, how come I'm buying here, but I didn't buy here? Why am I buying here at the top of the cycle, or why am I buying here and I'm selling here? That's wrong action. One is wrong action, one is right action. We call that wah-rah. Your right actions and your wrong actions, and trying to focus on doing the right action based on your model, your process, and not worrying so much about, did you have a winning trade or a losing trade. In this scenario, will be your stop above the high. Hey, Tintin, sorry, we were talking about the euro there. Sorry, I missed your question there. We were talking on the euro. Okay. Yeah. So when I talk about stops or risk, it's always, where's the risk? Where's my risk? That's what you want to be thinking about too. Because once I identify the edge, the next question is, well, how am I going to play it? And part of that is, well, how much am I going to risk? Well, you don't really know how much you're willing to risk unless you know where you're wrong, or what they call where your risk is, right? So on the euro, let's see. So long term, to me, when I start with where's my stop, some people just base their stop on amount. They have a fixed amount of money that they want to risk per trade. That's kind of a very novice way to approach trading. I mean, it's taught a lot in books, but I guess that's just something that just keeps getting repeated. That I only, my part of my trading plan is I will not lose more than $200 on a trade, and then I try to make 3 times that, $600. Well, okay, but the better way to trade is to say, well, where am I really wrong as far as my edge, the trend changes, or the cycle flips, or something that is other than just a dollar amount. Because what happens if I have my edge right, but I end up just being a little bit too heavy, and then maybe the market moves against me by $1 past my fixed amount that I'm willing to lose, and then it goes in my favor. I mean, because that's what brings me to these conclusions, that I used to try to do that, where, all right, I don't want to lose more than $500. So I'm going to keep my risk really tight, and I don't care if I'm just trying to be disciplined. And well, you take all these stop losses where you're at your $500 loss rule, only to see the market go a little bit against you and then go in your favor. You would have had a winning trade. And so you just have a lot smaller winning percentage, I think, traders that do that. So my way was to say, look, I need to care about where I'm wrong as far as the direction of the market. So what's going to change to make me wrong on the euro? When I trade big picture, I trade overnight, what I call, the core position stuff. I try to trade a little bit smaller over what I call a wider range of the chart. So like when I was trading treasuries, if a guy has a really big position, I mean, you're not like in the Forex markets or in the bond market. If you're short $1 billion worth of euros up here, and you sell into this level, the guy is not going to go home with a 200 pip stop. That's too wide of a range. They're going to get pretty nervous 30, 50 pips through the level. And that's true of when you trade with bigger size. you're going to feel a lot more nervous. You're not going to be able to sit through a 200 pip move. But I found it's easier to trade the longer term over a wider range of the chart and give myself more room. So how do you do that? You just have to bring your size down, so that obviously if you're short a million right here, that's going to feel a lot worse if you move back to 126 than if you're just short 10,000. But so what I do is I trade smaller size over a wider range of the chart. And so instead of trying to get really aggressive and pick one point in time and short a million, I might break up several sales, more sales over a longer time frame and over a wider range of the chart. And maybe I sell 100,000 here on the move up, and I sell another 100,000 here, and I sell another 100,000 here, and then maybe I cover some, cover 100 down here, and then we move back up and I sell another 100 lot. And if we go to 126, maybe I get a little bit more aggressive. I sell a 200 lot. But I'm starting to work an area like this 125, 126 area. And so to answer your question, where am I wrong? I probably wouldn't want it. I probably would, at this point, if I worked the trade on the euro back to 126, I mean, this is the top of the regression channel. Again, that's an area. So if I was aggressively short at this point in time, I wouldn't want it to probably go much above 127, and I have to stop or take some risk off. And then so what you get, so the way to work a position on the core side is you don't pile in on one trade and on 1 million and hope that you have the timing so perfect that the market moves immediately in your favor. Much easier to break up your lots and trade around the position. So I can sell here. I can come in and cover some on this day. The market can cycle back up. I sell a little more. I cover some. And all the while, I have a core short position that I'm adding to it. And then as it comes back down, I'm taking some profits. And I keep some of the short position on. Comes back up, you feed back into it. And it's that same ebb and flow that you can trade around a position longer term like that. And you want to hold some pieces for the bigger move if you get it. But you can do the same thing on the 1 minute. I mean, I don't really like to trade through lunch, so this is kind of a tough time to do some of these live trading sessions if we want to trade live together. But cable came up here today, and it's the same thing. You can slowly start going contrarian and fading it, because this was in an uptrend all morning. So when you start to day trade short sterling up here, you got to realize that you're going against the trend, which is okay. You just got to know that you're playing a contrarian. So it's not an aggressive. You don't play contrarian moves aggressive. You play them patient with smaller size. Same thing as what I'm talking about, over a wider range of the chart. And then as the cycle turns, it's much easier to kind of pick off the top if and when the cycle rolls over. So you could be doing the same exact thing here on cable on the 1 minute. You're just slowly shorting here some pieces. Then I get a topping tail. I get a nice wall here. Okay, now I got some things that I can use when I have an edge. The probability when I drop from here to here is a pretty good wall there. Let me zoom in. There's a pretty good wall right here. I can get more aggressive and short into this. Boom. I can short bigger lots, and then I cover some down here. And so you might hold some of these pieces that you sell for a bigger cycle, like the 30-minute cycle, and you hold those pieces. And you can first in, first out. It doesn't matter. The point is that you hold some pieces for a bigger time frame, and then at the same time you can add and get heavier on the smaller time frames and take some off and add some back and take some off. Can Forex be traded with the same? You mean TA? Is that technical analysis? Question is, how is Forex different than crypto? Well, and I've been teaching this for a long time, that the mechanics of every market is different, which again, that's back to things of chance. You know, there's um, there's lots of factors that make up every market that are a little bit different. So liquidity, you know, the different types of assets, why are commodities different than currency, blah, blah, blah. But as far as getting the direction down, it's all the same. Markets are, life in general is all the same. Everything cycles. It's just the way, it's just the design of the universe. You know, everything has a cycle, macro cycles to micro cycles. Your heartbeat, the way light travels from the sun, how energy moves in waves. It just is what it is. And so when you start to realize that that's the same type of dynamics that we study in thermodynamics and in physics, there's a lot of those same properties are in finance and in trading, because it's energy that's going through the markets. And there's these cycles are playing out in the financial markets on a small scale and a large scale. And so it's not that, you know, it's not the holy grail. It's just the point that there's energy, that's why these patterns exist and happen over and over and over again. You know, there's the psychology of trading, you know, news, all these different things move markets. It's just that you can trade my model. What's with the beauty of it on any market and any time frame. And so that's what's great, is that as a trader, you go wherever the opportunity is. You know, crypto will be in a bull market here probably for several years, but there may be times where it's in a really nasty bear market. That's true for all the asset classes. So everything cycles, everything has its season. But the idea of when you really let go of not having to know what's going to happen next, it's a very nice relieving. It relieves a lot of the anxiety that comes with trading or investing. It's a strange concept to people, because like everything you hear is always about trying to figure out what's going to happen next. But when you realize that you don't need to know, you just need to know where your edge is. And then you have to know how to play your edge. You know, I'm fairly confident that Bitcoin is going to see much higher highs above 20,000. But the question is when. And so it's not helpful. You guys hear me all the time talk about, you know, the same call that Bitcoin's going to $1 million at 19,000. You can make the same statement at 6,000. But what the hell did you do in between 19,000 and 6,000 matters, you know? There's a lot of people that got sucked into the highs up there. And you know, I guarantee you most of them didn't stay with the position down at 6,000. To always tell my guys, we want to trade what is. We don't want to build in our minds a scenario. That's the other thing with psychology of trading. The human mind, we like to take our beliefs, and a lot of times when we have a strong belief, there's emotion that accompanies that thought. And when you have emotion charging up that belief, it's a very I don't know if fortifying is the right word, but when you build up a belief like that, and it's true with religion or politics, it's very hard to change that mental state or that belief system or that one particular viewpoint when you build it up so strong. And so a lot of traders and a lot of people that are told their whole lives how smart they are, like if they're coming out of Ivy League schools and they think they're supposed to, and maybe they are intellectually very smart, but because of that sometimes hurts them because they're not flexible enough to say that they're wrong, or they approach markets with that same thinking, that instead of thinking that markets are more chaotic and more random than they are scientific, in the fact that, put this input in, I'm gonna get this input out. They don't embrace the uncertainty. And so the trader that can say, I don't know what's going to happen, but I know what I'm going to do if this level breaks. I'm perfectly happy with flipping my position if the market tells me I'm wrong, or the cycle changes, or whatever, and the market changes. I'm happy. I have no problems admitting I'm wrong and going the other way. The trader that fixes in his mind, one, he knows what's going to happen next, and that absolutely beyond a shadow of a doubt, this has to take place. When you fortify that belief, it's very hard to change it. But what the mind will also do is you'll start to block out all the information that goes against that belief. And that's kind of like a psychological pain avoidance thing that we do as humans. We don't like to be wrong. We don't like the way it feels to be let down from something that we believe is going to happen, and then it doesn't. And so you can see that in politics a lot. People will ignore whatever view just because they don't want to. It goes against their view. And so that happens in markets. You'll start completely ignoring the information when you're in a losing trade because you've built in your mind something that has to happen, but it's not necessarily reality. People, they know Bitcoin's going higher at 15,000, and then it starts to break 12,000, but they have that stronghold in their mind that it has to be $500,000 at some point. But the reality is that the market's telling you it's just not ready. It breaks 12,000. The market's telling you it's breaking the bands. It's telling you there's a chance it could go back to pi. Boom, that's exactly what happened. You cycled all the way back. So it's very dangerous to be rigid in your expectations when you're as an investor, as a trader. And one of the ways you can combat that is just embracing this idea that I don't need to know. I don't have to know what's going to happen next. I just need to know what is happening. What's the market telling me right now? What's the cycle telling me right now? And just go with what that, manage your risk according to what is happening, not what you think's going to happen, or what you want to have happen. None of that stuff matters. But I mean, I'm sure some of you guys have been in trades. I've done it plenty of times. When you're inside the trade, you only look at the information that tells you, oh man, this thing's going to go to new lows. Oh, I got this on short. I'm going to add to it because this thing is going to absolutely get destroyed. It's breaking. I got this one right. It's going to go to this level. Oh yeah, this is definitely going to drop to here. I'm going to short more. And then guess what? You end up selling aggressively into the lows, and the market completely reverses on you. And you start to ignore all the information, like, oh man, now this is actually in an uptrend and I'm still shorting it. And why am I being aggressively shorting this? And then as soon as you stop out and you take the trade off, everything becomes clear. And it's like, oh, I ignored this. I broke my rule here. I broke my stop rule here. I only supposed to trade my big lots with the trend. I'm completely was selling 2, 3, 5 times the amount I usually trade as far as my lot size, and that wasn't even with the trend. Why did I do that? Well, that's because you were blocking out all the market information. We have a bad monthly cycle on Bitcoin. I don't really I agree. I mean, this data is not the best right here because the cycle. I don't just the way the oscillator is built here. Right out of the gates, it was hanging out at 80. So it's a little misleading to think that I think that this oscillator is going to come all the way back to 20. That's just too much distance. That's if this cycle was started in the middle and it went to the highs, then it could come back to the lows. But when we look at just this oscillator, we've already had a pretty good we've already had a pretty good amount of time on a monthly cycle come down. So I don't think this continues all the way, you know. I don't think this is going to continue all the way to September like this. I think we're probably closer to an ebb and flow back the other way. I mean, this was a decent amount of time on this down cycle, and then we continued back up. I think you're probably in the late innings of this cycle. I wish there was a little bit more data. It would be a more pronounced, better looking cycle there as far as that indicator. But just from a price perspective, you know, you got the 8 here, which has defined this monthly momentum pretty well. And so we couldn't take out the prior month's high. That's telling you that the market's not ready to go yet. As soon as we have a monthly close above the prior month's close, that'll be pretty meaningful. We don't have that yet. We're kind of hanging right at the 8. But if you were to close the month below the 8, you do have the monthly chart would be telling you that there is a chance that you could go all the way back to the bands. I mean, that's the next signpost if you break the 8. Now, obviously, you have this low support level at 6,000, which was the low. That's pretty major. But those are the two big things I derived from the monthly chart. What was your point on that? We have a very strong weekly cycle. Yeah, so my long-term view is, I mean, here's the thing with fundamentals. I mean, it gives you a starting point, but it doesn't help you, like I said, it doesn't help you with the timing. If you really want to think about Bitcoin in its last days, when there's only a few coins and there's all these people that are mining and they're after one or two last coins, you could make the case that all the billions of dollars that are being spent to mine that coin between the aggregate of miners, that coin is going to it's got to be worth a lot of money if people are mining it and spending all these resources. So, I've heard some crazy valuations that kind of make sense, that if it costs billions of dollars to mine a coin in its last days, which what you guys know, what's the year, what's the time frame that the last coin is supposed to be mined? You guys are good on that. 2045 or something. I don't know. The point is that 2040, right? Around there. So, who knows? That's the thing. This market has so much potential because it's taking market share from the currency markets, the FX markets, which is in the trillions. There's like $7 trillion a day that changes hands in FX. That's volume, but the overall size of the world financial system is so enormous that there's so much opportunity for crypto to grab that market share. If Bitcoin wants to be a big part of that, there's no reason why the market share couldn't be a lot bigger than gold. I mean, gold is tiny compared to the world financial system because you can't stick the gold in the machine and send it back and forth. We can't use it in our computers. We can't, it's not, this is the digital age, et cetera. So there's no reason that Bitcoin couldn't far surpass gold. So my long-term view, could Bitcoin be 1 million? Sure. It could be a lot higher than that, but people can't really wrap their minds around that. And maybe something else replaces Bitcoin, or maybe the overall, maybe that's the top 10 cryptocurrencies that surpass the market cap of gold. So there's still a lot of room there. But from a trending and time perspective, I think, I think at some point we're going to make a new high. If we hold the 8 here and the monthly cycle turns back up, you could probably see a new high by the end of by maybe even as soon as before the summer. You know, we have 3-month reaction, and then the climb is pretty quick. These markets, once the momentum picks back up, and we know what can happen in these markets. But it's tough to say. Maybe it's the summer. If we break the 8 and we do have a really long monthly cycle, then maybe it's the back half of the year before we have another significant rally. But there's a lot to do between now and then. So there's a lot of risk management. When you look at the weekly chart, I really like that the weekly cycle finally bottomed. I mean, it had a pretty pronounced move down, and it started to turn up, and we had price follow. The price actually bottomed before the cycle turned. Sometimes that happens. So when we get near the lows on the cycle, it makes sense to start buying. You don't always have to wait for the cycle to cross to add. So the weekly cycle's there. It's just we couldn't get above the 8. So that 12,000 level was really major to turn this intermediate term momentum. So we have a lot of bearish intermediate term flow within the context of the long-term trend. So how you trade those two different, call them crossroads. A lot of times you're going to make your most money when the near term's moving in the same direction, the intermediate term's moving in the same direction, the long term's moving in the same direction. Well, right now you have an intermediate term trend that's right in your face, bearish, but then you have the long-term trend that's bullish. So that kind of twists people up, and you got to know how to work those two time frames. But when you have intermediate term downtrends, you got to really be patient with your buys, or there's great opportunities to hedge and to short against your longer term holds. And then when you look at the daily, there's a lot of good cycles and ebb and flow here. But I'm watching this 200. I put in our chat room last night. I don't really like to give the 200 a lot of significance when you've already chopped through it and it's doing one of these. So the 200 had significance the first time down. You can see the market actually bounced a little bit off of it, but then you went through it. So you traversed it once, you traversed it twice, and now it's just arcing here right below the market. I don't give it as much significance. We've already traded. You traded through it twice after cycling back to it. It's just, but a lot of traders have that on their chart, so people are buying there. So I want to see how we close today. See how we trade tomorrow. If we come back up tomorrow and you take out the high, then maybe that was it. If that happens, then maybe I'll put some money to work right there. And whatever you add, you put your stop below the low. But you don't have to. You can just wait and watch and see how price reacts. That's kind of what we're doing right now, is just waiting to see. If we can't really hold here, then I still think there's a good chance we drop into high again. This cycle is only halfway done. What else you guys want to look at? Cardano, I'm starting to get pretty bullish. Starting to get, trying not to get myself too worked up here, like too excited about Cardano down here. I just think that these levels, this is going to be a huge winner, or this thing just, I don't see how you can't make money down here longer term on Cardano unless it's going to go to zero and stay at zero. That's what's nice about, you've got such small, it's such an asymmetric trade that, so I've started to get more aggressive. I mean, I've really been patient here. I haven't gotten sucked into any of these, buying any of these lower lows. We waited for this pennant to form, see if we could break to higher highs. You couldn't. Took out that entire inverse bottom. But now I'm starting to see the opportunity, and probably a little bit early still, but that's okay, as long as you know that you're early. And then it's going to be interesting to see this play out. You guys can watch how we trade it. If we get this turn, I'm going to show you what it looks like to trade the right-hand side of a cycle. And there'll be a couple chances. There should be a couple chances here to get pretty aggressive. And I think we're going to see a pretty explosive move somewhere over here. You might even come sooner. I just don't see how this project, and this was the top 5 market cap coin, I don't see how this stays at 10 cents and over the long term. And if this is really a solid 3rd generation type blockchain type cryptocurrency, maybe this is something that is $10, $20, $30 at some point. I know the supply is a lot bigger, but it's all relative. So to get a move at least back to 50% of this move down, that's very doable. So I kind of want us to go to, at this point, if we go back to 10 cents, I think it's a huge opportunity. This is just a massive buy zone down here. I mean, you can work a position here. Is that kind of what you're asking, Santiago? Who was asking that? You got, this thing is going to absolutely, once it goes, it's going to rip. And then I haven't gotten heavy yet, but I'm starting to really, starting to drool a little bit that I want to start to get a little bit heavier at some point. And when I do get heavy, then you're going to see a lot more signals, because when I get heavy on something, I don't just sit on it, because that's a lot of risk. I mean, you have zero as your backstop, so it's not like there's that much risk. When you get heavy in the Forex markets, you can't just like go away for a week, so usually when you get heavy, you try to trade in and out on the much smaller time frames and really start to trade it around. There's a lot of little moves in here before the market turns. Let's look at some of the smaller time frames. So this is pretty textbook, just low. It's tough to buy lower lows. It's kind of an art to how you do it. So that's what I was kind of explaining earlier, that you just break up your lots and just trade smaller pieces over a wider time frame of the chart. And then when you do get your higher highs and you do get your, what we call a TMS change, and the trend changes, then you can start to get more aggressive. But I mean, from here, if we have another drop, probably another 5 cents to 15 cents, I'm going to add again, small, And then if we drop to 10 cents in a straight line, that's an opportunity to put some bigger pieces on, because if you drop in a straight line from here without a subsequent bounce first, well, man, this thing's going to be really poised to snap back. If it does kind of ebb and flow, back the other way here, that's okay. I'll take some off here into this bounce, right into the bands, into a lower high. And then that's okay, because if you buy some here and it bounces, you take some off. Okay, it comes back down. Guess what? Then you can buy it back, and you just kind of work the ebb and flow. And then at some point, you're going to start to get a higher high above the prior pivot like that. Then you can start to get more aggressive, and then you start to look for the higher lows to add. Like that. That's how you kind of trade a turn. You can almost follow the lower highs. And then, like if you had a moving average, like a lot of times a 30-period moving average will do that. And you trade the deep dips patiently. And then you come out of some on the bounce. And then when you get the turn, you're gonna start to do what we call a 30 halt. A lot of time you'll see price start come back like that, and that moving average starts to rise. Then you're on the right side to be aggressive. That's kind of the vision here. Wouldn't be surprised too that we don't get the low in Cardano until we get this next low on BTC. So maybe that's a retest of like 6,000, 7,000 area. You guys want to look at EOS or lumens? EOS. Got a lot of mixed opinions about this project. My attitude is always you're never going to know everything that's going on behind the scenes. It's much easier just to trade the model. But this was one of the strongest charts, no doubt. I mean, this is just an incredible, very healthy, strong chart. It basically quadruple topped up there. And then when you broke the bands right here, that was the end of the momentum. So there's really no need to be aggressively pursuing this one at all. Like I'd be waiting for some sort of the market to prove itself a little bit here. Price has got to show me something. Get above the 8, get above the bands, stop making lower highs on the intermediate term. But you are getting back to some locations where, here's this wall concept again. If I treat that as one giant candle, well, you're about halfway. So you're getting back into the batter's box where you're more than likely you're going to get a long-term higher low. It's just a matter of timing it up to where you don't need to be in a rush. I mean, you might retrace more like 80% of the move. Anything's possible. You could go all the way back to the base from after the ICO before you turn. So more than likely, though, this has pretty much just been straight down and one line. So I don't really like to buy lower lows. Building a position on Cardano, but I typically don't like to go chasing the lower lows, because even if you get a bounce, it could be pretty shallow, and then you get another move down. But this is so oversold that, yeah, maybe you do bounce back towards the bands right up here. But, okay, so you risk a little bit here. Are you going to, you come up to here, you got a good chance that you're going to make another lower high. I'd rather just wait for some higher highs and get above the bands before we got long-term bullish there. It's probably worth an add though. If you could nibble if you really like the name and you want to start a position. We played this a couple times pretty well. This was our last buy. It was pretty good. We took profits into the high of that candle. What was the other one? Oh, XLM. XLM. All right, Miller. Appreciate that. Let's see. Significant delivery on promises. Yeah, Rich. I'm not really sure the catalyst. You have an entire whole space that's that hasn't really delivered on a lot of projects. So that's just the nature of this market, right? It's all about anticipating that these guys can do great things. So I get that they haven't, but the point is though, when prices come that far and you have a floor, you know what your risk is. It's just a matter of, it's just really a matter of time before you get a catalyst for that particular token. But the catalyst could just be the market moves up. If the entire market starts to move back up again, Cardano is not going to just sit there at some point on a relative value basis alone. That would be your catalyst, just the cycle in and on itself. Sometimes the cycle is the catalyst. In other words, the reason it's gone down so much is the reason it's gonna go up. Kind of like when you look at oil, when oil went from $25 or whatever the low was to 60, when oil was really low, you knew that at some point the inflation cycle was going to turn back up. The price of oil crashes. Well, when you want to compare prices on a year-over-year basis, at some point when the oil is so low, any type of little move off the low, the percentage move, right? Percentage move off that low. When you start to compare, like in the inflation data and the CPI, the cycle for inflation data was to pick up was just because you're comparing data, you're comparing parts of the economy and these inflation numbers from levels that were so extremely low that the cycle is basically the catalyst for it to roll back up. Does that make sense? That's what you do when you're comparing comparable periods. That's what they call the comps. So it's so easy to beat such low inflation numbers because the levels were so low. Any type of uptick, well, that of course you're going to see an uptick in inflation because you came off of levels that were ridiculously low. And then that's the same thing that was happening up here at $66 oil. Well, you've had such high oil prices that when you start to compare the data, naturally those numbers are going to start to roll on a percentage basis. So that's why when the market, most of these people, especially old Wall Street, likes to think linear, that just because something's moving in a straight line and it can continue, it gets a lot harder to have subsequent higher inflation unless you kept moving oil above 65, 66, up to 70. That was the only thing that was really going to move your inflation up. People like to get all obsessing about wages, but it's a small it's a small amount of what we like to talk about as inflation, the CPI, and what the Fed looks at. I mean, it's not that on the margin. It's not that meaningful in the big picture of the economy. All right, Scotty. Hey, Stafford. Swing trading in cycles. It's getting to that point. I get that question a lot. You know, the cycle stuff, that's the person that has the best cycle stuff. I mean, I probably need to write a book here and kind of start putting a lot of these things together, because I don't really have one source to go to other than Martin Armstrong's stuff on cycle work. So, you know, if you study, I would just start there. I mean, I usually refer a lot of people to him, and you know, I'm a big fan of his. I've studied pretty much everything he's ever written. So if you go to armstrongeconomics.com, you can read about Marty's background in this company. But underneath writings, he's written so much stuff on just the overall markets. But you can read about history of markets, but this is some good stuff on the business cycle. There's so much here. His models and methodologies, that's pretty deep. His energy models, this is the best thing if you guys want to really, you know, he's obviously big into pi. But yeah, so on that note, for any of you guys that are new, I mean, what we're doing is we're in the stages of building out Block Edge Capital. It's going to be a digital asset management firm. This is a brand new asset class. You know, I recognize that. It's part of the reason why I left fixed income markets, which are absolutely dying from a risk-taking perspective. Interest rates so low. It's just, anyway. But this is a brand new asset class. We haven't had a new asset class probably since futures on interest rate products in the 80s. So it's exciting. You're going to see trillions of dollars move into digital assets. So we're excited just to help build that out and be a part of that. And then Rhythm, most of you know, this is we're currently in the private pre-sale. We haven't done a public ICO yet. And so I'm talking to several VC firms and some private money. And I don't know, some of these guys have some pretty lofty goals. We've been lucky to have some pretty significant advisors on this project. Manny, you guys can read about and look them over in our white paper. He just got back from the big event they were having in the Caribbean. And so there's some pretty lofty goals where some people that, you know, have made some serious waves and were in crypto that actually are looking at building a world kind of a digital currency bank in a sense. And so there's some talks that they want us to be part of that on the trading side. So anyway, that's kind of what we're doing here on Rhythm. Anybody that's interested in more on that, I'm happy to have conversations with you. Kind of, you know, just come into our chat room and let us know if you're interested in being a part of that. And then as we talk about all the model and the work I've done, jenkinsrm.com. Guys, you can get involved with us here in the chat room. That's really easy to do. All my work I did on the treasury market and Forex market, and obviously applies to crypto too. That whole training on the model and that course is right here. It's only $2,000. I try to make it I think this is probably the best value out there. I mean, I always tell the story. I've invested thousands of dollars to learn options. I think I paid $5,000 to learn an options course. I paid $12,000 when I was really young to learn Forex. But I just, that's an investment in yourself. That's a pretty small amount of money to invest in a skill set or build your trading skills that you can have for the rest of your life. All these concepts we're talking about. So I get into the 3 pillars of our model: analysis, execution, risk management. There's so many facets to that. All the psychology of trading, that's under the risk side. Analysis, trend and cycles. Execution is about how you work your size, bidding and offering, all the setups that we see, the buy and sell setups, all that stuff. So I put all my thousands and thousands of hours of trading risk and billions of dollars that I've traded in all kinds of markets. That's all in this training video. That's a great value. And then the group coaching, this is for anyone that kind of wants to take their trading to the next level. So we trade and we work on these concepts together in a group coaching environment, and we trade live together a couple days a week. That's, you got to kind of have a coach and a mentor if you really want to reach that different level of consistency. So you guys got anything else you want to go over? Doesn't really feel like Friday. Does it feel like Friday? I got to see what hockey games are on this evening. It's pretty nice here in South Florida. Might have to hit the Winks. Guys, also, hey Ryan, you're welcome. Santiago, you're welcome. Also, guys, you guys know where we have a podcast, right? Go to the bitcoinpodcast.com. That's a great way to just kind of, trying to put out a lot of good content. We had some guests on last couple. We're going to have a lot more guests on. We had my lawyer was on there. He's very educated in the space. One of my lead Ethereum developers, I think we're gonna have on next week. He's been working on blockchain for a long time in Toronto. But this is our show here, Buy or Sell What the Hell. And then follow me on Twitter too, guys. I've been working on some new analysis start putting out, and I think we're going to put that out in a newsletter. Yeah, my Twitter handle is at @DJasonJenkins. All right, guys. Well, it's been fun. Hopefully you learned something. Psychology of trading is pretty important. That's always one of my favorite topics. So I'll always have some more good stuff for you guys on that. And enjoy your weekend. Be safe, be good. We'll see. Keep an eye on that BTC Pi level, that cycle like we talked about. I think that's the main focus. We'll see how we close today around the 200. All right, Dims. Thanks, man. Yeah, you too. Have a good weekend. All right, everyone. Take care.